Here are 3 stocks that not only have a high dividend yield, but have also proven to be safe for investors. First up, we have one of the most known dividend stocks out there, and that is, of course, Realty Income. Realty Income is a REIT, a real estate investment trust, and it's famous for being a monthly pay-in dividend company. They buy stable single-tenant properties like convenience stores and pharmacies, and they lease them out long-term, with tenants actually being responsible for most expenses. This predictable income stream fuels steady monthly dividends paid to investors. They aim for reliable income and wealth generation for their shareholders. Think of it as owning thousands of Taco Bells and collecting rent every month. Those payments are shared with you as an investor. This stock is really known for being a dividend beast, a true dividend aristocrat. And they have recently increased their monthly dividend for the 122nd time. There aren't many other companies with that dividend status. They are truly one of those companies that have been able to consistently pay dividends to their investors each and every month, so 12 times a year. Not many companies actually pay a monthly dividend, and also not many companies, like Realty Income, have been able to have 104 consecutive quarterly dividend increases. And it shows dividend investors not only that they have a decent dividend yield, which we'll get onto in just a minute, but they can be trusted for reliable income. And this is why investors that are focused on generating a passive monthly income from their portfolios actually have this company in there. Realty Income currently have a dividend yield of 5.4%, which is pretty substantial given that they've been able to increase it so many times in a row. Recently, Realty Income have had an all-stock acquisition of Spirit Realty Capital. And Realty's CEO said this: "Spirit's assets are highly complementary to our existing portfolio, extending our investments in industries that have proven to generate durable cash flows over several economic cycles. We also believe this merger will strengthen our long-standing relationships with existing clients." And in recent earnings, they not only beat expectations, but they also raised their full-year guidance. With any investment comes risk, and when we're speaking about REITs in particular, the risk is often because of how highly sensitive they are to interest rate fluctuations. A high interest rate environment is particularly difficult for REITs because it increases the borrowing costs, which can have a knock-on effect to profitability. I personally use Seeking Alpha for all of my investment research, and if you want to check it out, you can have a 7-day free trial plus a $50 or the equivalent off in your area if you decide to sign up. I'll leave a link to that in the description below. But what you can see here is that I can see pretty much everything that I would want to know about a particular stock. I'm just currently on the financial section on the income statement, and what I can see here is that the total revenue for this company has actually been increasing, which is a good sign. Of course, you'd need to do some further research and some further digging, but Seeking Alpha has absolutely everything that you could possibly need. There is also this section here called charting. This allows me to easily compare a company to the index, the S&P 500. And what we can see looking at Realty Income is over the last 1 month, it's actually outperformed the S&P 500. That's probably due to the macroeconomic situation and interest rates coming down. If we expand out year to date, it's a slightly different picture, with Realty Income underperforming the index. Expanding to a 3-year period, again underperforming the index, and a 5-year period, a similar picture, not doing too well. Investors over the last 5 years would have made better returns putting their money into an S&P 500 ETF than they would Realty. However, this is a time for accumulation if this is a stock, a company that you believe in and you want those monthly dividends. A couple of members on my Patreon have been using this time to actually accumulate Realty Income shares at these current prices. I'll also leave a link to my Patreon. You'll get access to the Discord along with my weekly buys and sells and all of that good stuff in the description below. No one knows where the market is going to go tomorrow or next year or in 5 years' time. However, if interest rates do start coming down as it's being predicted, we should expect Realty Income and other REITs to have a much more favourable time, and maybe we'll see that reflected in the stock price. Next up, we have a UK dividend stock, and that is Legal & General. Legal & General are a massive financial services and asset management company, offering lots of different products and services from life insurance, pensions, mortgages, and investment management. They have a dividend yield of 8.1%, which is actually one of the highest dividend yielding stocks here in the UK. But not only do they offer a good dividend yield, but also they offer a safe dividend yield because they have been able to increase their dividends every single year since 2011, except in 2020 when they actually kept the dividend amount the same. If you are an investor in Legal & General, you will get paid dividends twice a year, once in May and once in September. The pension risk transfer segment of Legal & General's business has become particularly profitable. In the first half of this year, the profits from this segment alone covered 40% of the total dividend payout in 2022. So this area alone is not only helping Legal & General actually sustain their dividend payments, but also potentially growing them in the future. Like I said, Legal & General offer many different products and many different services, but their investment management is one of the leading global asset managers, ranked 11th in the world. And it could currently be quite a good time to consider this stock for your own portfolio if it aligns with what you're looking for, because actually they've been going through quite a phase of reorganization and restructuring in the company. So because this is a UK dividend stock, we will compare it to the FTSE 100 index instead of the S&P 500. So over the last 1 month, you can see that Legal & General has over 3 times outperformed the returns of the FTSE 100 index. If we expand this out to a year-to-date period, actually slightly different picture, and the index has just slightly overperformed. Perhaps that's due to some interest rate impacts and things like that. Expanding out to a 5-year period, FTSE 100 outperformed Legal & General, but when we actually max this out here, what we can see is that although the FTSE 100 has been in existence a little bit longer, Legal & General has actually had a much better return over the long term. Aside from the interest rates, what other risks are there with Legal & General? Well, one of them may just be the competitive space, and Aviva is one of the main competitors. However, if you are a dividend-focused investor, definitely have a look at the dividend stability, because actually Aviva have cut their dividends before, whereas like we've just seen, Legal & General have been able to grow them consistently for quite a number of years. The last stock on our list today is yet another REIT, but it's a slightly different REIT, and it's Arbor Realty Trust. They specialise in loan creation and servicing, mainly offering floating rate bridge loans, particularly in the multi-family housing sector, so apartment buildings. They are a mortgage REIT, which is a slightly different REIT type than what we've just seen with Realty Income. And they are one of those companies that have not only seen exceptional growth in terms of their dividends, which we'll get onto in a minute, but they've also had periods of time where their share price has appreciated very, very nicely. And this is quite unusual for a mortgage REIT, so it may be worth diving in deeper and actually having a look at this company. But of course, this is not financial advice, and just for full transparency, I do not own any of these companies inside of my own portfolio. You can see on Seeking Alpha that their dividend yield is 11.1%, so that is very, very high. And then when we go on to this dividend growth section and expand out to 10 years, you can see that they have been able to consistently grow their dividends for many, many years in a row. This company pays 4 dividends a year, so they are a quarterly dividend paying stock. They come in March, May, August, and November. They have a high insider ownership percentage, which could indicate strong confidence in the future of this company. And they have been buying back some of their own shares, which can be a very positive sign if it is also backed by strong financials. What are the risks with this one? Well, again, because it is a REIT, there is always the risk of the fluctuations due to the interest rate environment. Now let's compare them to the S&P 500. Over the last 1 month, up by 28%, which is absolutely fantastic. Maybe hasn't outperformed some of those high growth, high tech stocks, but very, very good and has outperformed the index. 6-month period, also very good and outperforming the index. If we expand to maybe a 1-year period, you can see that actually it has underperformed the index. However, given that this is a REIT, very, very sensitive to the high interest rate environment, it has still done quite well in my opinion. Let's now expand to a 3-year period. Hasn't outperformed the index, but still giving positive returns. And a 5-year period here, we can see a similar picture. Let's just expand to a 10-year period. And actually, although it has underperformed the index, it's got pretty close. And what you can see with a company like this, and it's similar with Realty Income as well, is that it's very, very volatile. Look at this period of time here with the orange line where it's absolutely dropped during 2020. And although the S&P and many companies and indices, they pretty much all did the same thing, some sectors were particularly volatile and dropped way harsher than others, and this is one of those. But you can also see at times when it goes up quite substantially. And that is why some people have been really focusing on accumulating REITs during times of high interest when the stock is knocked back and the share price is slightly lower, because in the hope that then when the interest rates come down, as all these things do because it's cyclical, they will see the return of that. Let me know if you own any of these stocks that we've discussed today in the comments below. Stay tuned for the next video, but until then, keep analyzing and keep investing. And don't forget to hit that subscribe button.